As the U.S. markets are currently closed, the last available price for 3M, ticker symbol MMM, was at the close of trading on Friday, October 10th, 2025. The stock settled at $103.50, representing a modest decline of $0.75 or about 0.72% for the session. Now, that simple closing number, that small daily fluctuation, is profoundly deceptive. It masks one of the most dramatic and challenging periods in the history of a company once considered the absolute bedrock of American industry. Many investors, particularly those new to online investing, might glance at the 3M name and think of a stable, dividend-paying stalwart, a safe component for a long-term portfolio built on platforms like Fidelity or managed through a service like Schwab Intelligent Portfolios. The common belief is that you are buying into a legacy of innovation, a bastion of safety. The reality, however, is that an investment in 3M today has very little to do with that comfortable past. You are, in fact, taking a position on the outcome of multi-billion-dollar legal battles and a corporate restructuring so significant it has fundamentally changed the very identity of the company. This isn't a sleepy industrial, it's a high-stakes special situation hiding in plain sight. The recent trading patterns in MMM stock tell this story with stark clarity. The price action over the past several months has been less about its core industrial or consumer product sales and almost entirely dictated by news flow from the courtroom and strategic decisions from the C-suite. For instance, the spinoff of its highly profitable healthcare division into the independent company Solventum, SOLV, earlier this year was a massive event. In the weeks leading up to and following the separation, trading volumes in 3M surged. Traders using sophisticated platforms from providers like Interactive Brokers were watching the arbitrage opportunities, while long-term holders using their Fidelity brokerage accounts were forced to decide whether to hold both the new SOLV shares and the remaining leaner 3M. The price action post-spinoff has been volatile, with the stock trying to find a new equilibrium. It's no longer buoyed by the stable growth of the healthcare segment, meaning the performance of its remaining divisions, safety and industrial, transportation and electronics, and consumer, is now under an intense microscope. Any sign of weakness in these more cyclical businesses, which are highly sensitive to broader economic trends, has been met with a swift reaction from sellers. We've seen the stock struggle to hold key technical levels, often selling off on higher than average volume when macroeconomic data suggests a potential slowdown in manufacturing or construction. This contrasts sharply with the momentum seen in names like Nvidia stock or Tesla stock, which trade on entirely different narratives of technological growth. 3M, by contrast, is trading on a narrative of survival and recovery. Institutional activity further illustrates this tension between expectation and reality. For years, 3M was a core holding for pension funds, dividend-focused mutual funds, and conservative wealth managers. Many of these have been trimming or exiting their positions, concerned about the open-ended nature of the legal liabilities. The two primary overhangs are the lawsuits concerning its combat arms earplugs sold to the military and the litigation surrounding PFAS, often called forever chemicals. These aren't minor legal squabbles, they represent potentially tens of billions of dollars in settlement costs. As a result, many risk-averse institutions have been sellers. However, a different kind of institution has been moving in: value-oriented and special situation hedge funds. These are investors who believe the market has overly punished the stock, pricing in a worst-case scenario for the litigation. They are betting that the final settlement figures will be manageable and that the underlying business of the new 3M is fundamentally undervalued. This is why you see such sharp swings in the stock. stock. It has become a battleground between those fleeing risk and those hunting for deep value. Many retail investors, perhaps using the Robinhood app or a SoFi Invest account, are caught in the middle, trying to decide whether this is a falling knife or a generational buying opportunity for a storied American company. For those who need a clearer picture beyond the stock chart, the company itself, formerly known as Minnesota Mining and Manufacturing, is a global conglomerate known for its deep history of research and development. Its business model is centered on creating innovative products across a wide range of industries using its unique technology platforms. After spinning off the healthcare business, the company's operations are now more focused. The safety and industrial segment produces things like respirators, industrial adhesives, and abrasives. Transportation and electronics makes products for the automotive and aerospace industries, as well as components for electronic devices. The consumer segment is the one most people are familiar with, home to iconic brands like Post-it, Scotch, and Command. For decades, this diversified model, fueled by a legendary R&D culture, was a recipe for steady growth and a consistently rising dividend, making it a favorite among those seeking investment help for stable income. The current challenge is that the profits from these solid, if cyclical businesses, are threatened by the massive liabilities inherited from past operations. The expectation was that this diversification provided safety. The reality, however, is that legacy issues from specific product lines now threaten the entire enterprise. The future outlook for 3M stock can be broken down into a few distinct scenarios, each hinging on the resolution of these core issues. The bull case rests on a timely and, crucially, a finite resolution to the PFAS and earplug litigation. If 3M can settle these major lawsuits for a total sum that is at the lower end of analyst expectations, it would remove a massive cloud of uncertainty that has been depressing the stock's valuation for years. In this scenario, investors would shift their focus back to the operational performance of the core company. If management can prove that the leaner 3M can deliver improved margins and capitalize on its strong market positions, the stock could experience a significant re-rating. This would be the moment where self-investing individuals who took a chance on the turnaround would be rewarded. The dividend, a key component of the stock's historical appeal, would likely be seen as secure, attracting income investors back into the fold. A clear path forward could make 3M a compelling choice within Fidelity mutual funds focused on industrial recovery or value. Conversely, the bear case is equally straightforward and deeply concerning. If the legal settlements balloon beyond the company's ability to pay without seriously impairing its balance sheet, the consequences could be severe. This could lead to a significant dividend cut or suspension, which would cause an exodus of the remaining income-focused investors. The company might have to take on substantial debt or sell off assets to cover the costs, hindering its ability to invest in R&D and growth for years to come. In this scenario, the stock would likely break below its recent lows and enter a prolonged period of underperformance. Any global economic downturn would exacerbate the situation, hitting its cyclical businesses at the worst possible time. The risk is that the company becomes a value trap, appearing cheap on paper, but continuing to fall as its fundamental situation deteriorates. This is the central debate that active traders on platforms like SoFi Active Investing or those with an interactive brokerage account are weighing every single day. The primary risk is not operational, it is legal and financial. The biggest unknown is the final price tag for cleaning up the past. The central question for anyone considering an investment in 3M right now is about this legal overhang. Let me know in the comments, do you believe the worst of the legal fallout is already priced into the MMM stock, or is there more pain ahead? In conclusion, the story of 3M stock is a powerful lesson in the divergence of long-held expectations and current market realities. The expectation is of a stable, innovative, and reliable industrial giant, a safe haven for conservative capital. The reality is that 3M is a company in the throes of a painful but necessary transformation, defined almost entirely by its struggle to quantify and manage immense liabilities. Its future stock performance will be a function of courtroom decisions and balance sheet management far more than the sale of its next great consumer product. The investment thesis has shifted from one of predictable industrial compounding to one of high-risk, high-reward turnaround. Understanding this profound gap between the company's historical reputation and its present-day predicament is the only way to properly assess the opportunity or the danger that MMM stock represents in a modern portfolio. The content shared on this channel is for educational and informational purposes only. It should not be considered as financial, investment, or